what an insane day yesterday was. Simply put, my friends. And it doesn't look like it's about to get any less insane anytime soon. If we look at the pre-market again, Nasdaq futures down 2%, S&P 1.5%, the Dow 1%, Nasdaq down 5% at one stage yesterday, closing in the green. Absolute insanity. And today I want to speak about this. The Federal Reserve expected to set stage for liftoff in March. Fed Day preview starts today. Everything closes up tomorrow. And there is a lot to be spoken about because this could potentially have quite large effects on the market for the rest of this week. So I'm sure most of you guys know that generally speaking, when Papa Powell comes out, when the Federal Reserve is speaking, the stock market can go a little bit crazier even than usual, and we definitely saw that yesterday. Now, I believe this was part of the reason. I also believe there was just an awful lot of fear in the market, specifically from retailers. We can see that here. Retail traders bailed on the markets right before stocks rebounded, and this one here hurts to see because it was just the everyday person who lost a lot of money yesterday, and the big money scooped up our shares nice and cheap. But we're going to speak about that, okay? We can see that small caps are starting to potentially outperform some of the larger caps again. The Russell 2000 has been showing us that. But yeah, just a few things to speak about. But the main thing is, what do we need to know now? What can we expect to happen over the remainder of this week? Are retail investors correct to be panicking, to be selling out, or are they maybe getting it wrong? So really quickly, guys, can I please ask you to hit that juicy like button? It helps me out absolutely massively. Drop me a comment down below. Let me know what you're doing with your portfolios at the moment. And please, my friend, subscribe if you're new around here. So jumping straight into it, okay? Ahead of the Federal Open Market Committee's two-day meeting, important to remember that it wraps up on Wednesday, not today, investors have been shunning risk assets and moving towards safer havens. I don't even think they have been. I think they've just been selling. Anyway, the major US stock averages dropped last week and ended Monday almost flat. But they forgot to mention after being down many percent, as treasuries rose, pushing down yields. The markets expect the Federal Reserve to guide towards a March rate increase and to provide additional outlook on its balance sheet roll-off plans. So before we get into real conversation, before we get into the meat of this, that's what needs to be understood. This should just be a little bit of an update realistically. We're expecting March to be a much bigger, much more important period of time. But if there are any upsets, that's what we need to be keeping an eye out for. That's what will affect the market in the short term. That's what will make the VIX potentially go crazy. So just keep our eyes peeled for that. If that isn't to happen, if everything goes to plan, if we just get the update that we expect, or potentially we get some better than expected news, stocks could look good. While Omicron is likely to weigh on January data, expectations are that its impact will be short-lived, and with inflation so elevated and the jobs market quite healthy, we saw that last month, there appears to be a very high hurdle for the Fed not to raise rates. And yes, that is simply true. I'm of the opinion it should have happened a little while ago. I think a lot of other people are as well. But anyway, we don't need to get into that. The base case, okay, so the base case that we expect is that liftoff is set for March as the first of 4 rate hikes this year, okay? Now, we don't need to speak about what absolutely everybody has to say, but a lot of people think it could be anywhere between 3 to even upwards of 7 or 8. But the first one happening at the March 16 meeting has been given a near 98% probability. So here's some scenarios discussed by economists and strategists, and I think this is actually a really well put together article because it gives a few different sides of the story. It gives some different perspectives, and there's also a couple more I'll speak about in another article or two. But anyway, so the more aggressive rate hike path. Dutch bank economists have argued for a tail risk of an even bigger hawkish surprise over the months ahead, with the possibility that the Fed raises rates in March and then goes on to raise rates 6 or 7 times this year. So again, there's people who think we could see even more hikes than potentially expected. But then we see Wells Fargo doesn't expect individual rate hikes to exceed 25 basis points apiece for 3 reasons. First, Omicron, which, is starting to look a little bit better already, but now there is supposedly another variant. I can't wait to have to get another booster. Makes the immediate growth outlook more fragile. Second, expectations that price pressures will ease gradually in the latter part of the year. And third, outsized increase of 50 or more basis points often have an unsettling effect on the financial markets. And yes, that one is very true. This is just a screenshot I took earlier, but the Fed is in a very tough spot, okay? MJP Wealth Advisors told Yahoo Finance Live. They know history has shown that if they move too quickly on interest rates, it adds to the risk of moving the economy into a slowdown and the risk of recession. And now people actually are beginning to speak about recession to extent. I know that financial education, Jeremy did recently, and it does become to an extent quite a real fear. So that's why it's so important to keep an eye on these things. That's why we want to be looking towards this, hopefully 25 basis points and not towards 50 or more basis points, because it does have an unsettling effect on the financial markets, and not just on retail investors, but on hedge fund managers, etc., etc. So that is something we have to keep an eye out for. We can't just blindly let this one pass on by. It will affect us all. And then there is this here. Wrap up the taper now. There is no reason for the money supply to still be growing if the Fed is serious about doing their part to corral inflation. Halting the bond purchases now would better align the Fed with the hawkish inflation stance and position them to actually let bonds begin rolling off their balance sheet as soon as March if deemed necessary. So again, there are all these different situations that can play out, my friends, and they all will affect each one of us differently. Balance sheet options, okay? Investors will be looking for clues on quantitative tightening and whether it involves a phased runoff of the Fed's balance sheet or more active sales from its portfolio, okay? This is going to affect us massively, our holdings, our individual stocks. Someone from Wells Fargo says, our guess is that the Fed will follow the game plan during the last round of QT in 2017 to 19 by laying the groundwork for a passive runoff of maturing securities sometime after the first 3 or 4 rate hikes between March and late this year. Active sales from its portfolio likely will be avoided at least until well into 2023. And I don't think too many people will disagree with this one. I think the large majority of economists out there seems to be on this side of the argument. So all that's well and good. Basically, all we have said, all the economists have said is a lot of different things could happen. What do we have to actually look for in the markets after the meeting, okay? Increased volatility will indicate that investors are worried that the Fed overshot. Such worries will show up metrics like the VIX for equities and the MOVE index for the treasury market. So VIX is what most of us investors are going to be looking towards. I don't think too many people in here are too tied up in treasury bonds. That's not really the YouTube space. The effect of undershooting policy normalization by the Fed can be expected to have a largely symmetrical impact on the market, with the risk that still ample liquidity ultimately risks boosting inflation and inflation expectations enough to prompt more aggressive policy tightening by the Federal Reserve later. But here is one that when I read it, I was doing all my research, and I really just like this particular outlook, okay? Fed speculation is developing an echo chamber quality. Markets are getting excited by market forecasts of the Fed. And it's very true. It's not really the best time to forecast the Fed. People speculating over what the Fed are about to do is affecting the markets much more than what the Fed are actually doing right now. The same couldn't be said March 2020, or for the majority of 2020, in fact, but it can be said now. Maybe I'm contributing to that problem by making this video, but I do still think that it's information that should be taken in and understood. I just don't think that we need to let it really over-determine how we invest. Now, I want to speak on this. Retail traders bailed on market right before stocks rebounded. So yesterday was absolutely insane. It was actually the first day that I have bought stocks in a considerable period of time, about 3.5 months. I didn't sell anything yet, so I was one of the people who thankfully got to buy towards the bottom. I did not catch the bottom, but towards the bottom of the huge sell-off yesterday. But I just want to speak about this and the mentality of what's going on here. In a spasm of panic selling early Monday, retail investors offloaded a net $1.36 billion worth of stock by noon. Most of it in the first hour, my friends, okay? And we all saw the rebound that happened. It was clearly retail investors had sell orders in for as soon as the market opened. Within the first hour, boom, a lot of the markets crashed. Small caps, mid caps. If we look at the top stock losers, I mean, we see lots of small caps and mid caps. We see GameStop, Novavax, AMC is in there. Digital World Acquisition went down 8%. Neo had a 9% drop. Arrival a near 10% drop. Virgin Orbit 17%. I mean, there is a lot in there of all different market caps. And a lot of these are the YouTuber related stocks. A lot of these are retail investor preferred stocks. So we're not seeing particularly huge names in there, okay? And that's because of things like this. And then people came in and scooped up those shares. And I'm sure that the large majority of that was the big money. So it looks like, there was a warning sent out to the everyday person. They were like, you sell, we are going to buy. And that's what the big money does. They bring stock prices down. They take our shares off us. They make us afraid and they buy them off us very cheap. So don't let big money shake you out that easily, my friends. And that's not me telling you not to sell your stocks. It's not me telling you to buy stocks. Obviously, this is just my thoughts and opinions. I am going to be selling some of my positions that I don't believe in anymore. But don't let big money scare you out of your favorite high conviction positions. The rush for exits helped drive the Nasdaq 100 down almost 5% in Monday morning trading, and it ended in the green. It's possible the news wasn't entirely bad for bulls. On the lookout for signs of seller exhaustion, okay? Major averages staged a breathtaking reversal in the hours after the wave of sell orders land, one of several such turnaround in recent weeks. In the short term, it's a good indicator that retail investors are capitulating, which is leading to perhaps a temporary bottom, okay? But this is important. While retail traders are at last showing signs of resisting the dip, another investor class at the center of turmoil has yet to capitulate. That is hedge funds. So while hedge funds, okay, their equity exposure and leverage has been falling, okay, the decline was much in line with the market's drawdown. So simply put, fund managers have yet to actively unwind their positions, okay? A lot of it's just because the market has gone down. It is retail investors largely causing a lot of these stocks going down. And it's quite clear to see. Look at the retail investors' favorite stocks. Look at the Wall Street bet stocks. Look at the YouTube stocks. They're the ones that are getting destroyed for the most part, okay? They really, really are. You'll see here popular stocks. AMC, Airbnb plunged as much as 12%. There was many more examples. It is retailers leading this sell-off. It shows anxiety and individuals deciding that they got to reduce their exposures. They just can't take this. I mean, maybe that's what a lot of this comes down to. A lot of people simply can't take all of this bleeding. A lot of people simply can't handle all of the red that they're seeing in their portfolios. Maybe it's the first time that this has happened. They started investing last year. Everything they threw money at, boom, went up to the moon. They didn't take enough profits. They didn't take out initial investments, etc. And they can't handle all of this bleeding. And I think that point can be exaggerated again when we look at this, okay? Yesterday, the biggest gain of the day was in the Russell 2000 index of small cap stocks. It briefly entered bear market territory before posting a gain of 2%, okay? Small caps have been hammered to the ground, okay? And a lot of the time, retail investors love their small caps. I'm in many of them. I'm sure many of you guys are. And there was a lot of selling in these. They were going down a lot quicker. That's why we didn't see Apple, Amazon, Microsoft dropping down 40, 50, 60% as we saw with a lot of small caps or growth stocks. Even companies like Palantir and Corsair Gaming's, okay? But now we see small caps. I know it's only one example. There are a few more out there. On certain days, outperforming mid to large caps. So maybe that is a sign that things are getting back to a stage where retailers are willing to buy. I think what the coming months and potentially the entirety of 2022 is going to come down to is conviction and believing in your picks and not necessarily getting caught up in the noise. Following all of the news, okay? Following everything that's coming from the Federal Reserve, keeping up with economists and strategists, listening to them, taking that information in, but ultimately understanding that everybody's in their own position, everybody's in their own situation, and you need to be able to decide for yourself what strategy you want to adapt going forwards. But that's really what I want to say. I wanted to get this video out to you guys nice and quick so that you can be aware that there may well be some extra volatility, if that's even possible, over the next couple of days. Maybe we're going to have another day like yesterday over the course of this week. We're going to have to wait and see. But if you watch this video all the way till the end, you, my friend, are a true legend, and I really do appreciate you being here. From the bottom of my heart, your support means the world. Boom, I love you guys. If you enjoyed the video, could you please hit that like button, maybe drop me a comment, subscribe if you're new around here. All that helps me out absolutely massively. I hope you have a beautiful, blessed day. I'll see you in another video very soon. Peace.